In a previous video, I talked about how markets are now flooded with liquidity, pushing almost every asset to record highs. So here's the question: with US equities rising this much, are valuations still justified? After the pandemic, the Federal Reserve unleashed massive money printing, drove interest rates down to near zero, and the US government ran trillion-dollar deficits. Liquidity flooded the system. Even though the Fed raised rates aggressively in the following years, the huge amount of money it injected was never truly withdrawn, while new deficits kept piling on. The result? Stocks broke records and gold, Bitcoin, and treasuries all surged to new highs. There was simply too much money chasing assets, pushing everything higher. For a while, almost anything you bought went up, and the market looked euphoric. But the real question is this: at such elevated valuations, are US stocks still worth buying? Several indicators suggest valuations are now at historically extreme levels, not just record highs, but levels that echo some of the most dangerous moments in history. So, is this a real investment opportunity, or the edge of a bubble? To find out, let's start with 3 core measures. First, the simple price-to-earnings ratio. The S&P 500 is now around 29 to 30 times earnings, while the historical average is only 15 to 20, nearly double. Looking back, before the dot-com bubble burst in 2000, the PE was close to 30. Before the 2008 financial crisis, it was around 20. In other words, today's level is very close to the peak of the dot-com bubble. The second, and perhaps more important, is the Shiller CAPE Ratio, the cyclically adjusted PE. Unlike the regular PE, the CAPE ratio uses 10 years of inflation-adjusted earnings, smoothing out short-term volatility and showing long-term valuation levels. Put simply, it tells us how many years of average earnings it would take to earn back the cost of a stock. Right now, the US CAPE ratio is around 38 to 39. At the peak of the dot-com bubble, it hit 44, the highest ever. Before the 2008 crisis, it was around 27, high, but still well below today. Take Tesla as an example. Tesla's CAPE ratio is now around 327. That means, based on its past 10 years of average earnings, it would take 327 years to break even. Compared with the auto industry median of just 18, Tesla's valuation is far beyond industry norms, an extremely expensive level. This shows that the CAPE ratio isn't just useful for markets overall. Applied to hot individual stocks, it highlights how extreme valuations can get. The third indicator is Warren Buffett's favorite, the ratio of total market cap to GDP. Today, US equities are worth more than 200% of GDP. Back in 2000, during the dot-com bubble, it was about 159%. Before the 2008 financial crisis, around 110%. Today's level isn't just higher than 2000, it's far above 2008. A classic bubble signal. Buffett has often warned, even the best company, if bought at too high a price, will destroy value. He has also called the Buffett Indicator one of the most reliable tools for assessing market valuation. When the line reaches the top of the chart, it's like pouring gasoline on a fire. And his actions reflect this view. Berkshire Hathaway's cash reserves are now at a record high, over $340 billion, making it one of the largest private holders of US Treasury bills. For 11 straight quarters, the company has been a net seller of stocks, and has not repurchased its own shares. Buffett has often stressed the importance of patience. Real opportunities don't come often, and when they do, you need to be ready with cash on hand. He isn't panicking, he's waiting, sitting on the sidelines until prices make sense again. In short, all 3 indicators show US stock valuations at historically rare extremes. The PE ratio is back near dot-com bubble levels. The CAPE ratio is close to its historical peak. The Buffett Indicator has broken through past records, and Buffett himself is holding record amounts of cash. High valuations don't mean the market will crash tomorrow, but they do mean future returns are likely to be squeezed, while risks are rising sharply. At the same time, today's market is not the same as before. The Fed's balance sheet shows liquidity several times greater than in 2008. On top of that, sovereign wealth funds, petrodollar capital, and cross-border money moving through Bitcoin and stablecoins are all adding to the flood. This makes today's liquidity far beyond anything after the financial crisis. As investors, we can't predict the exact moment when things might break. But we should at least be clear. Today's US stock market is no longer a place where risk and reward are in balance. So what do you think? Share your thoughts in the comments. And don't forget to like and subscribe to support the channel.